My pleasure to introduce our presenter today, Rebecca Smith and Garth Tebay. Rebecca is a director and member of GBQ Consulting, focusing on the areas of litigation consulting, forensic accounting, and economic damages and business valuations. She's also served as a court-appointed expert. She's a lecturer and instructor on many topics and is amazing. We also have Garth Tebay, who's practicing certified public accountant and holds many certifications. He's a founding partner and managing partner of Value Defined. And we'll just turn the time over to them so they have time to tell us all about how to deal with the wonderful things we're dealing with in the world. So it's all yours.
Great, thanks so much, Alex. Welcome. So I'll be on video. Garth is not. You can Google him if you need to have listen to him. I'm also going to stick some headphones here because it sounds like I'm getting a lot of reverb. So let me do that. Okay, so it's not getting that when we practice, so I apologize for the short delay. We do have a lot. Oh, there you go. You guys can see what Garth looks like. Great. We do have a lot of ground to cover, so we're gonna try and move quickly because I'm assuming most of you financially minded people on the call will sort of make sure that we do this at a level where we know you all have a basic understanding of some of the financial issues here. We're going to go through what the Paycheck Protection Program is pretty quickly because what this is really about is the debt forgiveness part of it. And then we're going to talk at the end about what it is that you can do to help your clients if they have or want to get a PPP loan. I have a caveat here for any of you who have been paying attention. You know that the guidance is coming out on a daily, sometimes twice or 3 times a day basis. So this is what we knew as of April 23rd, and I will actually be supplementing it with some information that we learned after April 23rd and some things that even happened today if anybody was watching CNBC or paying attention to any of the news this morning. So having said that, the last thing I'll say about that is the other piece of information that I found out today from a banker is that what the SBA is telling the banks is that the final guidance on the debt forgiveness should be issued in or around May 15th. Little startling to know that it is going to happen that late. 2 more weeks from now where we'll have clients that will be weeks into their loans, unfortunately. But it is what it is. And so all of our information about the programs and the debt forgiveness is coming from the CARES Act and the Treasury FAQs and the interim rules that have been released to date. So with that, I'm going to turn it over to Garth to give you guys an overview of the program.
Okay, so a lot of people are very familiar by now with the Paycheck Protection Program loan. And if you hear us refer to it as the PPP loan, that's what it is. And we're going to go over some of the basics in case somebody on the call today needs a little bit of a refresher. These loans are provided during the period of February 15 through June 30th of 2020. They're 100% backed by the SBA. Now they're administered through commercial banks. Any commercial institution that is registered for FDIC can administer these loans. These are non-recourse loans as long as you use them for authorized purposes. The loan under SBA Disaster Loan Program, and we're going to probably refer to that as the EIDL loan, Economic Injury Disaster Loan Program, after January 31st, 2020, may be refinanced under this program. So you can have both programs, proceeds from both, as long as you use them for different purposes. This is exclusively for small businesses. So it's based on companies that have less than 500 employees per location. And franchise affiliations are also covered. Next slide. Next slide. There we go. So this is a fairly busy slide, but if you look at it, it's looking at how to qualify for the two different loans, what the loan amount is, the use of the proceeds, and what the interest rate is. Under the EIDL loan, it's less than 500 employees, for-profit, not-for-profit, veterans organizations, tribal businesses. It's interesting, they've included sole proprietors with or without employees, independent contractors, and co-ops and ESOPs with less than 500. Under the Paycheck Protection Loan, again, it's less than 500, same groups included. It covers sole proprietors, independent contractors, and self-employed individuals. And we'll talk a little bit more about that as we go through today's presentation. The loan amount for the EIDL loan is up to $2 million based on a formula. Frankly, the latest I've heard, and Rebecca will be able to inform us, that the EIDL loan is really going to be a fairly small amount, and it's really not designed for the COVID-19 epidemic. So I don't see that as a primary source of funds. Our focus today is going to be on the Paycheck Protection Loan. It's up to $10 million. It's based on a multiple payroll, 2.5 times average monthly payroll. And we'll talk about what payroll is. And plus you can add your EIDL loan to the outstanding amount if you had an EIDL loan outstanding. Now, both of these programs are limited as to what you could use them for. So you have to, and we'll be referring to these things as covered costs. So under the EIDL loan, you can use it for payroll, paid sick leave, payables, debt service. Under the PPP loan, you use it for payroll and non-payroll essential costs, which will include payroll costs, benefits, salaries, commissions, mortgage interest, rent, utilities, and interest on debt, if it's incurred before February 15. And the interest rate, if you have an EIDL loan, it's 3.75%. Unless you're a nonprofit, it's 2.75. And the Paycheck Protection Loan has a very low interest rate of 1%. Next slide. Next slide.
Did it advance? Do you have what? This
There
is one
it
you
is.
wanted?
There.
Sorry, it's
Yeah,
just a little
there you
slow
go.
for you.
Oh, okay. So this is a very important slide, and you're going to hear about this as we go through the presentation, because what's important, oh, I just lost all video. Oh, great. Okay. Rebecca, I just lost all video.
Would you like me to talk while you get it back about what payroll does include?
Yes, I would.
Okay, that would be great. Do you mind muting yourself while I talk so we don't get reverb? And then just let me know when you're back and I'll let you pick up. So Garth is absolutely right. What payroll includes is very important, because this definition is both for dollars on the way in and dollars on the way out. So the payroll, there was a lot of confusion about this at first, but it's very clear now that payroll is going to be gross payroll is the starting point of that measurement. So if you pay an employee $1,000, if you pay an employee $1,000 and they have $200 of FICA and federal withholding, the $1,000 is the measurement for the gross payroll number. And it includes salaries, wages, commissions, cash tips or the equivalent, payments for vacation, sick leave, dismissal or separation pay. To that, in the definition of payroll, you add any payments for group healthcare benefits, and that's the company portion of maintaining group healthcare. We've had a lot of questions from people that say, well, what about life insurance? What about disability? Our reading of that is pretty strict, that it's group healthcare and not those other things, but we also think that would include dental and vision. And then payment of the employer's portion of the retirement and payment of the employer's portion of state or local tax. So that does not mean
state or local tax withholding. You aren't going to add that to the gross wages because that's already being deducted from that. If you are a sole proprietor or independent contractor, then it's going to be any wage, commission income, or net income from your self-employment. So like your Schedule C. Garth, are you back in business?
I am.
Okay.
Can you hear me, Colin? All right.
Hey.
What's important about this slide, besides all the details, and there's a lot of details there, is that there was some confusion, at least early on, about whether this was going to be measured based on gross pay or whether it's going to be measured based on net pay. There's been different articles on that topic. I think clarity certainly indicates it's based on gross pay. So when you go through to calculate what is included in the payroll, you would use the gross pay. As far as reporting on the independent contractors, I'm at a loss. So I'm going to be more interested in listening to Rebecca on that topic. I've had lots of questions, and it's definitely a topic. As Rebecca indicated, we get stuff every single day on this. So we're all learning as we go. Next slide. Okay, so when we talk about payroll, there's certain items that are not included in payroll. And so compensation in excess of $100,000 per employee is excluded from payroll. So some of your planning might be that if you have individuals that are over 100,000, possibly during this 8-week period that you're going to be measuring the spending of these covered costs, maybe that compensation would be limited to 100,000. If it is not, then anything over and above that does not count towards loan forgiveness. There's various taxes, and you can see the chapters and code sections. Just basically, the employer's portion of FICA, both the Social Security and Medicare, and also FUTA, those are not covered costs under this particular program. And compensation to an individual where their principal place of residence is outside the U.S. are excluded. You cannot double count. So you've probably heard a lot about tax credits that are available under the CARES Act. If you qualify for the PPP loan, you don't qualify for the credits, and vice versa. So you can't double count under these programs. And then payments to independent contractors. This is really an interesting one. So the independent contractors can get their own PPP loan. So therefore, you really can't include the 1099 contractors in your PPP loan. They would get their own. Next slide. Okay, and then I think this is the last one I'm going to be going over. We're going to listen to Rebecca. We're going to talk about the term of these two loans, the debt forgiveness, which is the real important part that probably most of us are on the phone call today. Deferral of payments, personal guarantees, etc. So the term of the EIDL loan is up to 30 years. And the Paycheck Protection Loan is a 2-year maturity. The loan gets paid back over a 2-year period. The debt forgiveness, there is none under the EIDL loan, but under the Paycheck Protection Loan, it's possible that a portion of your debt will be forgiven up to 100% of the debt. And it's going to depend on a couple variables. The first one is the mix between the spending on payroll versus non-payroll expenses, and Rebecca's going to go over all of that. And there's a second measurement that she'll talk about today, and that's the FTEs. And there's going to be a base period that the FTEs will be calculated. That'll be your base. And then how quickly you bring people back to work will be the other measurement, and that ratio between the covered employees during the 8-week period to the base will determine what portion of that loan is going to be forgiven. Deferral of payments under EIDL, it's a 1 year, up to a 1 year deferral. For the Paycheck Protection, payments are going to start after 6 months. There is a personal guarantee on the EIDL loan over $200,000, and there is no personal guarantee, no collateral requirement. Now, there is a collateral requirement under the EIDL loan, and they're going to be looking for things like real estate to secure the EIDL loans. There's no prepayment penalty, so if you were in a position that at the end of your 8 weeks, you had a portion of the loan that was not forgiven, you could pay it back if you wanted to, and that prepayment would not be penalized. Credit elsewhere is also waived, so they're not going to look at your other credit. Approval documentation, it's varied across the board. I'm sure with almost everybody that's on this presentation today. The rules basically are that for the disaster loan, it's going to be based pretty much on credit score and alternative methods to determine ability to repay. For the PPP loan, it's based on good faith certification. You're going to go through a series of questions in the application. You're going to certify whether or not you are qualified to get this loan, and they include that you're using this for COVID-19, that you're going to fund payroll, mortgage, lease, utility payments. There's no other applications under any other program, and you haven't received duplicate payments. Rebecca?
Okay, so we're getting a lot of questions, and I want to assure a lot of that you guys, these questions are generally, I think most of them, scrolling through, we're going to answer a lot of them as we get into the forgiveness. One that I just wanted to address right now is someone asked if Bureau of Workers' Comp could be included under the state taxes, and we have taken the position that it can, and we've been successful with some banks and unsuccessful with others. So it is a little bit of a case-by-case basis in terms of what the banks are looking at in terms of what a state or local tax is. But a lot of the other ones are around the $100,000 limit. We're going to get into a lot of this. The other question that kind of was like a theme as we went through is people asking questions if bonuses would be included in payroll. The answer is that it is, but as we get to the forgiveness and some of the new guidance that's come out, we're gonna talk about sort of the business necessity of that and kind of, you know, game playing and maybe what you should or should not do. Okay, so right now we have a lot of clients who've applied. Many of our clients have been funded. Some of our clients are still waiting, and as you know, as of yesterday at 10:30, they reopened the portal to fund the other additional $300+ billion. I heard that did not go well yesterday, that it was not nearly as smooth as it was thought, and there is a lot of rumors that that money is already sort of spoken for, if you will, that the banks, what they have in the queue is already likely committed for the applications that are in process. So this has been kind of crazy. I think there is a likelihood that not everybody that applies will get the money. I also think based on some things that we're going to talk about later, there is a likelihood that there will be a third round, but I'm just going to sort of leave that out there and we'll get to that. So let's spend some time really digging into the debt forgiveness, because obviously this is the part of the program that is the most appealing part of the program to people, the idea of free money. So how does the debt forgiveness work? First of all, you can get forgiven up to the amount of the loan. It seems rather intuitive, but you can't be forgiven more than the amount of the loan, although I do believe that the accrued interest will be forgivable if the loan itself is forgivable. Garth talked about the 1%. A lot of questions about this from several of you about, is this taxable? The answer is no. The debt forgiveness is excludable from gross income. So as you're advising clients, I would suggest that Garth, do you mind sticking yours on mute? I'm so sorry. I'm getting a reverb again. I think it's my computer. I apologize. We're advising, but definitely take yourself off mute if you've got something to weigh in on here. Debt forgiveness is forgivable from gross income. And so we're advising clients to set up a new chart of accounts that will record this as a loan when they get it. And then when they get the debt forgiveness, they'll need to record that as, PPP debt forgiveness, so that it's very obvious that we don't include it. We had some clients that wanted to bounce it up against their expenses. What we understand from this is that the expenses will still be deductible. If we didn't allow for the expenses to be deductible, then the debt forgiveness itself becomes functionally taxable. So we've done enough research on this that we feel comfortable that it's excludable from gross income, and the expenses that you use to pay this will also be deductible. So the intent of the CARES Act in this particular thing is to provide companies money for sort of their operations, if you will, their base operations. So their intent is that for the 8 weeks after the date the loan is originated, that's what the language of the CARES Act is. I think practically what people are using is the date the loan was funded. So if you were funded on April 20th, the 8 weeks that follow that take you through, I think, June 10th, is that their intent is that you use the money on payroll, interest payments on mortgages, both real and personal property incurred prior to February 15th of 2020, rent and utility payments. One point of sort of interesting observation is that the CARES Act also said that one of the allowed uses was interest on other debts incurred prior to February 15th of 2020. So they kind of had 5 uses allowed. And the Treasury FAQs also have those 5 uses allowed, but in another FAQ, sort of a page or 2 later, it only lists these 4 uses in terms of what will make up the debt forgiveness. So it seems to imply that the allowable uses might be a little bit broader than what will be forgiven. So in the interest of being conservative, as we move forward with our clients, we are taking the Treasury FAQ literally, and we are only including interest payments on mortgages, both real and personal property, and not including interest on other debts, though we are sometimes running those numbers both ways for clients as we kind of anxiously await this guidance that now looks like it's maybe more than 2 weeks away. As Garth alluded to, there's a reduction in your forgiveness for reducing your head count, but then there's also what I would call a cure provision, a relief provision. The utility payments is also a little bit of a vague thing. What has been defined now as utilities is kind of what you would think of as your usual suspects, right? Electricity, water, gas, sewer. But then they also said that it was telephone, internet, and transportation, which has led to a very heated debate among professionals about, does telephone include cellular telephones? Well, it didn't say that it was landline telephone, so we've also been taking the position for now that we believe telephone will include cell phones. Transportation is kind of the most vague one. I've seen a lot of people who think that that the transportation is fuel for your business. We're hoping there's going to be some more guidance. That sort of seems to make sense to me, you know, if you need to move your business forward. But again, no definition of what transportation actually is, so sort of subject to interpretation. Okay. So step 1 in the debt forgiveness is we're going to create a pool of eligible dollars. And so that pool of eligible dollars gets created in that 8 weeks after the origination of the loan, okay? And it's going to be payroll and then non-payroll. And the money has to be forgiven. The language actually says no more than 25% of the dollars should be non-payroll expenses. And that's going to basically be calculated off of how much payroll you spend. So it's, you know, pretty easy. If you have a $100,000 loan and you spend $75,000 on payroll, then you could have the additional $25,000 be non-payroll. But if you have a $100,000 loan and you only spent $60,000 on payroll, then that's going to limit how much non-payroll you can have, because it still has to be in a 75-25 ratio at a minimum. Now, that doesn't mean you can't have a $100,000 loan and spend $90,000 on payroll. You can spend more than 75% of it on payroll, but that ratio has to be at least a 75% payroll, 25% payroll. We get a lot of questions about, can I prepay my rent? Can I prepay my utilities? The CARES Act was pretty explicit that you cannot prepay interest on mortgage debt. We think the guidance is going to come out is also going to say that you cannot prepay other expenses. And the basis for that is the way that the language in the Act reads is that it is expenses that are incurred and paid during the 8-week period. So we are interpreting that to mean no prepayments. So that also then means that, but we do interpret that to mean you could catch up. So let's say you got a deferral on your February rent or March rent. If you wanted to catch that rent up, you've incurred it. It's an obligation you've incurred, but you would need to, you would need to pay it then during the 8-week period. You have not incurred July's rent, so prepaying July's rent would not be available. And also, I'm going to tell you the level of scrutiny on these programs has really gone up, and I wouldn't want to be advising my company or my clients to play any games like that, because there's a good chance that there's going to be some pretty, a lot of eyes on these companies that get these loans and spend them. Just to make sure we're all on the same page, or if you remember the definition that Garth gave us of payroll, the payroll includes group health care paid by the employer and retirement benefits paid by the employer. So when you're trying to remember what that payroll is, make sure you go back up to that definition, that it'll include the medical insurance and it'll include the retirement contributions. So
Can you hear me, Rebecca?
Now I can hear you. I couldn't hear you.
Okay, I think they muted me. So I just want to clarify two things. This whole accounting during the 8-week period is really based on when it's paid. So thinking about the cash basis, it's when the payroll's paid. And there's a lot of clients asking, well, the payroll was for 2 weeks ago. No, it's based on when it's paid. The same way payroll reporting on W-2s is. It's based on paid payroll, paid expenses. And the second thing I just want to throw out, I know Rebecca is certainly knows about this, but today the U.S. Treasury did announce that they're going to be auditing these loans over, what was it, Rebecca, 2 million?
Yeah, we're going to talk about that later, Garth. Yeah.
Okay.
Definitely on the agenda as we get there. So, yep, 2 million is the number. So, yeah, you don't want to be playing any games because this is going to get looked at. So, absolutely. Okay, so then step 2 is the workforce retention. And so this is where they're going to look at and say, did you achieve the objectives of the CARES Act and keep people employed? And so this is measured based on full-time equivalent employees. We are currently using the definition in the ACA because we don't have a different definition, and we think it's reasonable to use this definition. The CARES Act also references the ACA. And going back to Garth's point about this, just to make sure everybody was clear, what we're hearing is a lot of questions about whether this should be cash basis or accrual basis. And what we are advising clients is this should be a cash basis measurement for that pool of dollars, because it's incurred and paid. The paid is the really important part there. So if your payroll is paid on a Friday, if you were funded on Thursday and you're paid on a Friday, you run your payroll on a Friday, that Friday would be included. Okay, so as you go over to the FTE calculation, the way this is going to work is you get to choose between one of two baseline periods. It's either the average of the FTEs from February 15th of 19 to June 30th of 19, or the average FTEs from January 1st of 2020 to February 29th of 2020. It's at the company's option. They get to set the level. And then you're going to compare that baseline of average FTEs during to the average FTEs you had during the 8-week period, and this is going to create a percentage. So if you had 100 FTEs during the baseline period and you had 90 during the 8-week period, that's 90 to 100 is 90%. I know you guys are all numbers people. That 90% gets applied to the pool of eligible dollars. So if you had a $100,000 loan, you spent it the right way, 75-25, but you only had 90% retention of your FTEs, you're going to get 90% forgiveness. However, there is a trigger that you can cure this and sort of take it to 100%. So the act and the guidance says basically if you restore your workforce to one of those baseline levels by June 30th of 2020, then even if you were at a 90 or a 10%, you're going to get a 100% in terms of the workforce retention. Now, obviously, people are saying to us, well, great, I'll just hire everybody back on June 29th and then fire them on July 1st. Look, the way the act reads, you absolutely could do that. But again, we expect that there will be some further guidance about that. But for now, all it says is you have to reinstate your head count by then. It's not the same people, it's simply an FTE count. So if you've lost certain people, you just need to replace them. And you can pay people to not work just to get your FTE count up. We have lots of clients who are going to be paying employees to be on call in order to reemploy them. There's also then a second reduction. I think this is the one where we're looking for the most guidance. But basically it says if you've cut someone's pay and then that person makes less than $100,000, then there's going to be a further reduction in the debt forgiveness. This also has like the cure provisions where you can put them back to their pre-reduction levels as of June 30th. So if somebody was making $90,000 and I said, look, instead of firing you, I'm going to drop you to $45,000, the cut has to be more than 25%. Then there's supposed to be some additional penalty. But frankly, as we think about this, we struggle with this one because the penalty is I'm going to have less dollars. So I'm going to have a smaller pool for step one. So I think this is the part of the calculation that most of the firms are saying that they really need some additional guidance on before they can understand the math on this one. And just to demonstrate this, we have a lot of clients personally at our firm that are restaurant clients and retail, and so they've cut hours on people. And so, as we look at this and we think about somebody where we've decreased the hours of an individual, that's going to impact your FTE count, whereas decreasing someone's hourly wage is going to actually hit you maybe on this payroll reduction. So I have a very simple example there where I have one employee and I show the math that if they were working 30 hours with $10 an hour, and then I just cut their hours to 15, well, I'm getting hit on the FTE head count because I've gone from one full FTE to half an FTE. But then if I further reduce their rate to $5 per hour, that's the kind of situation we think where you're going to see some type of additional penalty for reducing wages. Okay, in the interest of time, I'm going to move through these examples pretty quickly. Since you're math people, I don't think I need to spend quite as much time, but I do think it's helpful. What I want to demonstrate to you here is that sometimes the buck is not worth the bang in terms of getting to forgiveness. So here's just a hypothetical. We have a loan of $500,000. The loan's funded at April 15th. In the 8 weeks after April 15th, they spend $472 on payroll, $25 of rent, $12,500 of utilities, and so they actually spend more than the loan amount. They've got FTEs in the 2019 time period of 64 and FTEs in 2020 of 71, and then they had 65 average FTEs during the 8-week period. So they're clearly going to pick 64 as their base because that's the lower number. So as we look at all of those tests, well, the percentage spent on payroll is 92.7%, so that's great. That exceeds the 75% and means that the non-payroll expenses are not more than 25. Even though they spent more, they can't get more than the loan forgiven. And when we look at the workforce retention factor, ta-da, they have a 65 out of 64, so 100% of their loan is forgiven. I can tell you, having done this calculation for lots of our clients, this is not the way that it's working out. So let's take this one. We have a loan of $2 million. They only had payroll costs of $350. That's because this company had laid off a bunch of people, but they still had fixed expenses of rents and utilities and interest on their debts. They had 180 to 194 people before, but now they only have 40 people during the 8-week period. So as we create the pool of eligible dollars in the top half of this, they've spent $350,000 on payroll, which means their non-payroll dollars are capped at $116,666. The math for that is you basically take the 350, you have to divide by 75%, multiply it by 25%, because it's really like solving for X. It's based on how much payroll. So my pool for eligible dollars is 466,000. Technically it's $666 too, but I just rounded. Because I only had 40 out of 180 people during this time period, only got 22.2% workforce retention factor, which means that only $103,000 of my debt forgiveness my money spent is forgivable. This is what's working out for a lot of our restaurant clients and our clients that are shut down. Now, if I trigger that June 30th clause, then you can see your debt forgiveness goes up to 100%. And now all of the dollars I've spent are forgivable. And then I have a choice with the rest of my $2 million loan if I want to hold on to it or if I want to return the rest of that money. Some clients are saying at 1%, they're happy to hold on to it. So what we've done here then is said, okay, well, what if you want to hire back some of your people because you want them to be on call or you do have some work that you could do for them, you know, and legitimately hiring employees back, right? We have lots of people who want to say, well, I just want to put my family members on payroll so I can get my FTE numbers up. You know, our advice to people who want to do things like that is they better make sure that there is a legitimate business purpose for that, which we're going to get to a Treasury FAQ that has really heightened our awareness and concern about this issue. Simply adding people, family members to payroll to spend the government's money and push your FTEs up, I don't think is going to be looked upon very kindly. So when our clients ask us that question, we're advising them to think, you know, to treat those transactions as if you would a independent third party. But let's just say this is a business who actually brought some people back. You can see we've got in the baseline column in the triggers June 30th, what I had shown you on the last example. In this case, they spent $200,000 more. They brought 23 more FTEs back. You can see without triggering June 30th, it actually cost them $200,000 to get $152,000 worth of forgiveness. That doesn't seem really worth it to me. But if they can trigger the June 30th clause, then, sorry, one of my boxes is in my way. If they trigger the June 30th clause, now the $200,000 has gotten them $266,000 of additional forgiveness. And that's because if you look here, that maximum non-payroll number has gone up. And that's because the payroll number has gone up, which has provided them more breathing room to be able to do that. So the very last example, I'm just going to go right to the math because you guys know what I'm doing here. This is a fairly small one. They spent $18,500. Their maximum amount of non-payroll would be $6,166. Again, we had to sort of solve for that back into it. We're able to retain very few of their employees, and so a very little amount of what they spent is forgivable. Again, if we trigger that clause, then at least everything they've spent becomes forgivable. And on this one, they had actually had some pretty significant non-payroll costs, but because they were in essence really shut down, it kind of leaves them hamstrung because they don't have the payroll factors. we did the same thing, the same analysis here. And this is the kind of stuff that you can help your clients with, is looking at what you can do to help your clients maximize the debt. So here we looked at it and said, well, if you spend, you know, a little bit more, or you trigger the clause, or you bring some people back, you can see that it gets you some additional forgiveness. All right, Garth, we only have about 15 minutes left. So do you want to sort of talk real quick about, you know, just kind of your experience helping clients before we roll into this last part here?
Sure. So I would like to say we've got several roles that we play. The first one is, if the client has not applied for the PPP loan, I would say time is of the essence. You've got to get that immediately done. This is, you know, we're like racing against a clock that just is getting spent down quickly. And so getting the loans in there immediately is something you need to advise your clients of. And then the second part, which is what Rebecca talked about, is clients are looking for help on how to keep track of the spending over the 8-week period and how to maximize loan forgiveness. There's a couple tools that are out there that track the spending compared to the two measurements, both the 75-25% rule as well as the FTE rule. This is an area you could really help your clients on, is to help them understand what's covered, what isn't, help them understand how to keep track of this, and meeting with the client close to the 7th week, closer to the 5th or 6th week, to start figuring out how we can best utilize these funds and be able to maximize the forgiveness if that's the goal. The third piece that I think is as important as monitoring the forgiveness, and that is establishing a strategy with clients as to, is forgiveness our primary goal or is it not? I think that most everyone that gets this loan is focused on the forgiveness part, and there's a tendency to hire people back, put them on call, they're going to sit home, get a paycheck. At the end of the 8 weeks, we've blown through the money. Yeah, we got it forgiven, but we really don't have any money left to bring back anybody. And when we need them, there's not going to be any funds. So in some cases where we have clients that are either not able to open up because of government restrictions, or they're going to have to take time to ramp up in certain cases where there is, again, either a ramp up time or government restrictions, then consider whether or not you should not focus on forgiveness, but maybe focus on retention and the amount of money and cash flow that you need in order to operate the business as you ramp it back up. And Rebecca's going to talk a lot about how to do that consulting. So Rebecca?
Yeah, thanks, Garth. And Garth has worked with a lot of his clients really closely. And I think the other thing that I want to emphasize for you guys is you really have an opportunity here to step up and help your clients in a way that they are not going to forget. This is a really difficult time for all businesses, including our own. And so, you know, just sort of reaching out to them and offering them this help is really solidifying relationships. And I think Garth would tell you that his clients have been incredibly grateful to him. Okay, so here's the different ways you can help your clients. And let me just also say, guys, I'm trying to monitor the questions, but there's 194 questions. And so we are obviously not going to be able to answer all of those today. But what we will do is put those in a Word document as a FAQ, answer them, and then have NACVA send these out to everybody who's on the call so you can see all of them. I also want to sort of just say that we have done this at GBQ several times. And so if you go to gbq.com/coronavirus, we gave a webinar about this about a week and a half ago. There is an FAQ out there from that one that has somewhere close to like 300 questions in it. So you may find some of your questions a little bit quicker there while you wait for some of our answers on this. So feel free to jump on the GBQ website and use any of those resources. But So you can help your clients create a plan. What I was trying to demonstrate with those examples is that it's not quite as straightforward as it looks in terms of just bringing people back and getting more debt forgiveness. So you want to start with your clients to help them maximize a plan that makes good economic and business sense. To Garth's point, some people might just need this loan to be able to stretch a little further. And you can use it after the 8-week period. So, you know, you can use it after the 8-week period for whatever things, you know, these purposes. And I'm seeing some people say because it is a 7A loan, you can use it for whatever 7A purposes would be allowed, which are a little bit broader than just the PPL purposes. So you have to talk to your clients about what's their priority. You know, is it survival? Is it forgiveness? You know, kind of what's the combination? You need to be talking to them now. You cannot wait till week 5 or 6 because it might be too late to figure that out, to rehire people back or for them to execute on a strategy. So what we're doing is we're helping our clients put together a budget for the 8-week period. We're putting that through a debt forgiveness model to say, well, what does the baseline look like? So what's your baseline? If you just keep chugging away the way that you look today, what does your debt forgiveness look like? And for some of our clients, they're like, that's great. I'm happy to get 60% debt forgiveness. I'll pay the rest back. I'm thrilled with that. For other people, they're now then looking at strategies to maximize that debt forgiveness. And so that's performing these what if scenarios to achieve those objectives. So when are you going to be reopened, or if are you going to be reopened during the 8-week period? Do you need to hire some people back? What kind of restrictions might you have in place that you couldn't even hire all the people back because you wouldn't have enough space? What's going to happen with your levels or your sales levels? Are there some things that I got deferrals on that I really don't want to have deferrals on? So if I deferred rent or utilities, does it make sense to pay those deferred rent and utilities in this time period? If I had an employee that I didn't pay, you know, does it make sense for me to do some catch-up pay on that employee that I did pay cuts for? Have I had problems attracting people to come work for me? So have I had to pay, you know, am I needing to pay some shift premiums or some retention bonuses that have a real business justification to them? Those are the scenarios you can help your client work through once you help them build the baseline plan. You've got to balance that 75-25 rule. So occasionally, you know, we're finding that it does make sense for clients to bring on, you know, some employees to be able to get some more debt forgiveness on the non-payroll items. For some folks, it's making sense to keep people that they might have furloughed, reduce their salaries by 25% so they don't trigger that other clause. That keeps them as one full FTE, but gives them a little bit of, you know, leeway in terms of creating some cash flow for them. Like I said, hazard pay, signing bonus, shift premiums. The biggest point, though, I want to make here is that there needs to be a real business justification for this versus playing games. And we're going to get into that in just a moment as we talk about a new FAQ that came out. Okay, then it's about monitoring the plan. So we've also developed for our clients a one-page tracking sheet that they can populate each week as they start to pay payrolls, as they start to pay utility expenses. So that way that we're making sure that they're executing against the plan. Like, things are going to change. Things are changing every day. We're going to get more guidance. And so the only way to be able to react to that guidance is if you are helping the client track this. Now, we have some clients who built their own models. That's fine. We're still having weekly touch base calls about where they're at, or biweekly calls about where they're at, checking in on their business, seeing what's changed, and keeping them up to date on what's going on. So really playing that trusted advisor role and taking the information to them. The application for debt forgiveness, this is going to happen after the 8-week period. This process is going to be driven by the banks. And that's one of the things, too, that we have been sure to sort of point out to our clients, and I think behooves you to point out to your clients, is that the ultimate person who's going to make the decision about forgiveness is the banks, according to the CARES Act. So you want to make sure if there's anything that's on the fence that you're pushing that back to the banks. So that's really important. And then they're going to need documentation, sort of a paper trail. Our best practices we've been advising people is to put it in a separate account and not commingle it, and then just fund the money over to your operating account as you pay it. But you can see here, this is the list of what's going to have to be certified and submitted to the lender in order to get the payroll. So I do think there's a role for us to also help our clients put those packages together with a nice, pretty calculation and work paper on top to make it really easy for the bank to forgive their debt. One of the questions that I see that keeps bouncing up here as we go back, well, I won't go that far back. There seems to be sort of a recurring question about the $100,000 and if that's prorated. The answer is yes, that $100,000 cap that Garth told you about in the payroll expense is prorated over that 8-week period. So I think I mentioned this, set up a separate bank account and know what the bank's going to be requesting. You're gonna need payroll records, copies of canceled checks, bank statements, et cetera, et cetera. Okay, so I really wanted to make sure we had a little bit of bandwidth to cover this issue. Last Thursday, you guys might have seen some of the blowback in the news about the public companies getting their PPP loans, and the sort of small companies didn't. Whether that's factual or not, that's what's being portrayed in the media, and so that has become problematic. The Treasury issued this FAQ, and in the FAQ they said that although the CARES Act waived the credit elsewhere test, which is what Garth talked about, and the credit elsewhere test basically says the SBA would say, hey, could you get a loan somewhere else? Do you have a line of credit? Do you have cash? Well, don't come to us until you've tapped out your credit elsewhere. So they waived that, meaning that the borrowers did not have to prove that they couldn't get credit elsewhere. But what this FAQ says basically is, look, you had to make a certification, and the certification was current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. And the keys there are economic uncertainty and necessary to support the ongoing operations. I think a lot of our clients were really focused in on the economic uncertainty and less focused in on the necessary to support operations. But then the answer continued and it said, it is unlikely that a public company with substantial market value, and I can't read it again, and access to capital markets will be able to make the required certification in good faith, and such a company should be prepared to demonstrate to the SBA upon request the basis for its certification. And then it said, if you screwed up and you shouldn't have taken this, you can pay it back by May 7th, which is interesting with the additional guidance coming not till May 15th on the forgiveness. I do understand that puts some companies in a tough position. So the question is, what does this mean? I would also say that today on CNBC, I think it was on Squawk Box or something, Secretary of Treasury Mnuchin said that they will be auditing all loans $2 million or above before forgiveness will be granted. So what it means is the sort of eyes on this, there's a lot more scrutiny and a lot more eyes on this. And we have been getting a lot of questions from our clients, and frankly, some of them are getting chatted in today, that are a lot of questions that are like, kind of how do I game the system, right? Can I prepay this? Can I up my own owner's salary? Can I pay my mother? We don't think that that is the intention of the program or the CARES Act. It certainly is not. The intention of the CARES Act was to get people back to work. And based on this FAQ and based on Mnuchin's comments today, we think that those types of things, if discovered, are going to be very problematic for clients. So one of the things that you can do is get with your clients and talk about how they're planning on managing their PPP loan and make sure that they're not doing anything untoward that's going to cause them problems. The second thing I think you can do along these lines is I think you can work with your clients to help document this economic uncertainty and the necessary portion of it from the certification. We have been having lots of conversations with our clients about what does that documentation look like. It might just be that is some type of a memo to the file that goes through the uncertainty around projects or customers. It may look at metrics one year to the next to show that as of the time of the loan application, they were experiencing slowdown. If they have 13-week cash flows or projections that they were doing that showed that without this money, they were going to have to lay off people. For some industries, this is going to be far easier than others. I think, restaurant industries, this is going to be a lot easier, although I will note that several of the names that have returned their money are restaurants. I think Ruth's Chris and Steak and Shake are the two notable ones on there that have returned their PPP money. So I do think you have a big role to play with your clients in talking to them about this and walking them through, like, what was your thought process at the time when you applied for the loan that made this loan necessary to support operations. The final thing that I just want to point out here before we run out of time, additional language that says borrowers must make the certification in good faith, taking into account their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. Look, our role is helping clients sort of project the future. And so just because you had a line of credit or you had cash available, that doesn't mean that the right answer would have been for you to completely tap into that and suck your business dry just to keep people employed. Having these PPL funds for a lot of businesses allowed them to preserve that capital, keep people employed, which is part of the primary objective of the CARES Act, and then be able to preserve that capital for the long haul. I mean, I think we know this is not an 8-week problem we're facing, even though we're getting 8 weeks of funds. So I think there's just a huge role here in this whole debt forgiveness process, from start to finish, as well as the documentation, for you to really provide a valuable service to your clients and make sure that they are set up for the best success that they possibly could be, which I think is what that was. It is, I think, exactly 4:00. And like I said, what we will do is we will get these questions compiled. We will answer them. We will circulate the Q&A with the answers. You guys had a lot of amazing questions, and I really appreciate you sticking through this with us. Again, make sure you go, feel free to go to our website. There's a Q&A. Somebody else has probably asked the same question you have. So thanks so much. Colin, I'll turn it back to you.
Great. Thank you so much, everyone today, and Rebecca and Garth. And we've got a whole bunch of seminars or webinars that continue to be presented. And if you want to go to, they're all free. Go to macpa.com and go to /COVID-19 is where you'll find those free webinars. This webinar will also be, has been recorded, and we'll place that on that page as well in a couple of days. So other than that, we'll send out the answers to all the questions that Rebecca is going to graciously put together for us. So be patient for those, and have a great day.